Hey, good evening, guys. This is Ken at Tortoise Capital. This is open office hours, a new feature I'm starting up here on Thursday nights at 8 o'clock p.m. Central Time. And my intention is to keep that room open for an hour and then talk about question or answer questions from anybody that shows up, student or not, subscriber or not. So we may in the future see folks from the foundations course or any of the other uh, coaching and teaching courses we do, or from our operational traders. And welcome in the future to any folks from the new project we've started at slice-app.io. Slice-app.io, where they've invited me to come be a teacher, coach, and mentor for a new startup on social media that they have, that offers a subscription and at reasonable prices, and gives me a chance to, show our materials and provide some education to a wider audience than we have traditionally addressed. So, what I thought I would do in this session tonight, since this is brand new and maybe the word hasn't gotten out yet, is Alex and I tonight. And what I thought I'd do is go through uh, the trades that I was taking and how I am trading with the advanced hybrid swing strategy on the Slice app. And what it'll do is it's going to show a lot of different of our standard patterns and how I'm using different time frames, but also how I sort of blend different time frames and strategies together into a meta system. So, what I thought I would do first is just say hi to Alex and ask him to just make a few comments. He's been a student for a while. He's got a full time job and he's not really in a position to do a lot of day trading. It's not really what he wants to do, but he's been able to adapt our fractal patterns to day trading time, or I'm sorry, to daily charts, if I should say. And so, Alex, if you wouldn't mind saying a few words, because I think you're in a position that a lot of folks who are using our material are in, where they're not full time day traders,
Yep.
but they're looking to incorporate some, daily bars or swing trading into their strategy. So I appreciate your being here and your patience. And how are you doing tonight?
Yeah, thank you, Ken. See, I appreciate first the material that you have provided over the years. It's being refined every time, and it's becoming more and more clear for the I guess the lay folks like me. I do do their swing. I guess I can say that swing trading
Yeah.
on the daily bars, and I found that it's basically my discipline that fails me if I keep doing things in a disciplined way. I achieving the results, meaning profits, most of the time. But then something comes up, and my attention span drops
Yeah.
for a few days, and I don't actually take their actions from the signals, and then I realize that what opportunities that I had, they're gone, and I need to wait for the next ones, and that sometimes hurts me, and if I don't sell in time, that hurts more. So
Yeah.
the principles that you gave us, I highly respect it, and it's a discipline that you know where my results are suffering. Yeah.
Yeah. Okay. Yeah. So, what I want to say in general is the edge that we have when applying our systems comes from this idea here that the market is filled with a bunch of herd animals that are driven by fear and greed and are impulsive actors, and that professionals have an advantage when we can manifest like a set of disciplines and rules that we're going to abide by that allow us to benefit from the psychological impulsive moves of the herd. The herd gets moved by things like fire and lions and lightning strikes. And so they can be very, very impulsive. And those movements that are triggered by fear and greed are temporarily irrational, by which I mean, in the long run, you can see why it's an overreaction to a certain condition. That's typically driven by the survival instinct and limited information and surprise and knee jerk responses that are always driven towards take immediate action in a powerful way to flee to safety or to grab as much as you can while you go. So, fear and greed, which drive the markets, can be exploited predictably and reliably and statistically by professional traders who've studied the behavior of the herd and can reduce it to a set of statistically based rules that allow us to take advantage of normal and abnormal moves of the herd that are driven by fear and greed. So it's difficult being professional. That's why it's a job and it's hard work. And most people don't know how to be professional or are not willing to put the time and cost and effort into being professional. And it makes you act against your basic human nature sometimes. Human nature impulsively makes us want to act like herd animals. And even when you've committed to being professional, you're still a human. And there's always that urge in every trading situation to, to revert to the herd. So we have to establish some kind of strong boundaries to insulate us from the urges that come out of the herd. Like it wants us to behave in fearful or greedy ways, and we have to have a firewall, a protective barrier that allows us to take advantage of our professionalism and abide by our rules, which we're then going to study with math and come up with evidence-based adjustments to our rule set so that as the market changes and the herd behavior changes, that our professional rules can adapt to it in a professional way. So that's what we find that our advantage really comes from. Now, the way we're going to manifest that, I'm going to show you over in here how I have been trading and how I typically trade with what we call the hybrid swing. A hybrid swing system means that I'm using swing trade timeframes where I'm going to hold things overnight, maybe as much as 2 to 10 days, while there's a temporary advantage as a swing trade. But I'm also going to use the information of the swing trade to set up intraday opportunities. And so I'm going to use a combination of day trading and swing trading. And I can be larger intraday because it's a liquid market and dynamically changing price. And I can have tighter stops and therefore larger positions for the same amount of money. And I can use the day trading to generate cash to fund overnight risk for swing trades. And I could use swing trade information to find likely candidates for good intraday moves. And we're going to see some of that today. So their combination of day trading and swing trading allows us to use fractal patterns and standard checklists and procedures to trade on any time frame. The pattern that we like is something that has had an exceptionally good move and then has sold off sharply and then started to reverse. And now we can identify those turning points with indicators. And we can establish that as the trading range. And if we divide that into fifths or fourths, we can say when it has reversed and begun its reversion, maybe I can assign one of these as my risk unit and say, I'm ready. If it continues, I'm ready to go long here. And now I have the possibility of 1, 2, 3, 4 units of reward for the 1 unit of risk that I'm taking, and that gives me a 4-to-1 mechanical advantage. Now, it may not go that far. Like it may only go a 50% retracement. Maybe it only goes from here to there. But now I'm going to have the possibility of 2 units of reward to the 1 unit of risk. I like this pattern a lot. We call that the supported spring crossing because this is like after a harsh winter, it is beginning to be spring and it has crossed a threshold. So we call that there is support at this turning point for a reversion back to the previous swing high or even just 50%. So that basic idea is going to allow us to see opportunities to be able to frame a trade with mathematical precision, to use statistics to determine if this sell-off is wide enough and this risk box is manageable enough that we can actually execute a trade in our preferred time frame. And if it only retraces halfway, I still get 2-to-1. And if it goes up halfway, I cash a win and it continues, I can maybe re-enter and still have a calibrated set of reward to risk ratios to determine if I have a favorable moment. To do that, we're going to use a set of standard symbols that have a mix of sectors, like ETFs and sectors, I'm going to show here. And then some things we call story stocks. And these are things that have reasons to believe that based on the location or the pattern or the volatility or its recent behavior or the fundamentals behind it, there's some reason why this candidate set of symbols has a greater than average chance of making a larger than normal move in a shorter than average period of time. That's what we would call a compound critical state. So we have a set of symbols that we focus on to choose from individual stocks as well as ETFs. And so I draw that distinction that ETFs and sectors behave differently than story stocks. These tend to be sharper moves, more volatility, sometimes nonlinear behavior, whereas ETFs and sectors tend to act more like ocean waves, longer, smoother, maybe not as large of a move, but more reliable in that sense. So what we're going to do is we're going to take the set of all possible targets that are in the market, and there's tens of thousands of those, too many to manage. So what I'm going to do is take a representative sample of different parts of the market and then concentrate on those in my stack so that no matter which part of the market is moving up or which part is moving down, there will be some representative member of that in my watch list that I can focus on. So wherever the action is in the market, I'm going to be able to find a target that's moving, and that way I can focus on maybe 50 symbols instead of trying to master 10,000. So we're going to concentrate on about 50 symbols at max, and we're going to look at 3 or 4 different patterns to emphasize that work on any time frame. They're fractal in that sense. And what I'm going to do is I'm then going to combine my understanding of my own self-psychology, the characteristics of my trading system, and then the dynamics and the dimensions of the market. And I'm going to try to get some synergy between those. And so if I can bring that over here and say, look, if I can find psychology and systems and markets, I can find where they all overlap. Now, what I actually have is a sweet spot that allows me to trade a system that's robust at a time in the market that's appropriate for that system, and where my psychology allows me to trade the system according to its rules, and I can behave in a professional manner instead of in a impulsive, emotion-based manner. So that's going to be the essence of our ideas. Now, the way I'm trading in the hybrid swing is that I'm looking for, in a single trading day, opportunities where something opens here, then has a possibility for a large move in either direction. And if this was yesterday's candle or a bar chart, and say it that way, I'm always interested in any breakout from yesterday's high, that's going to be information that there's new buyers that are coming in that are pushing it higher than they could get to yesterday. So I'm always mindful of where price is in its location compared to yesterday's high and in yesterday's low. We would call this yesterday's range as the yellow zone. And I can trade inside the yellow zone when I measure this out and I divide it into, let's just say 4. And if I see a sell off and it holds at yesterday's low, and I can define that as my risk, and it's moving up, I could have 1, 2, or 3, or maybe even 4 units of reward just to get back to yesterday's high. Then and only then am I allowed to trade inside the yellow zone, because I have an opportunity to frame that trade as a at least 2-to-1, preferably 4-to-1. And then if it actually gets up to the test resistance area and breaks through, and I have money in hand from this trade, then I can look to add a second position on the breakout from the previous range. And by the same token, if it violates below yesterday's low, then I have what we call a collapsing dragon, our favorite pattern, and we can follow the fear to the downside. So that's the way we're looking at the intraday trade. Now, if I have a swing trade, I might have had something like what we call the 5-day down, where I have 5 lower closes in a row. That's usually an overreaction kind of a move. And what that tells us is that if we take yesterday's range and we see it open inside that range and it breaks out, then it looks like this could be a reversion back to the previous 10-day high. And that might be a good swing trade that lasts, 2 to 5 days. But if it starts actually moving, then the day that it actually starts making that move, this is an ideal time to day trade that inside of that first day move. The beginning of a swing trade is a great day to be a day trader. So I can use a list of about 7 different swing trade mechanical patterns, all of which have specific rules, and they give us signals for good potential swing trades. I can take that list and then frame those and maybe have an opportunity to trade them during the day. So that's an example of a hybrid pattern where I'm using the swing trade information to give me good candidates for day trading opportunities. And then I can use the statistics that we generate to determine if the size of that daily range permits me to trade inside the yellow zone, or do I have to wait for a breakout? If it was a very narrow range, like it ended in a doji, there may not be enough room inside that doji to trade intraday. But if it breaks out of the doji, well, then I have information that the swing trade is working, and I could actually use the doji itself as the size of my swing trade risk. And as long as it stays north, then I can have a good trade. So in a practical way, that's what we mean by hybrid swing trading. I'm using day trading techniques on swing trade candidates, and now we're going to see how that actually manifests. So when I'm trading intraday and I'm using the model portfolio at slice-app.io, what I basically organize this is my little like artist's palette or cheat sheet. I am working with a $1 million practice account, and I'm measuring the risk in thousands of dollars. So when I'm swing trading, I usually think of one of 3 levels of risk where I get 0.2% of portfolio risk. So I would be risking $2,000 or 5,000 or 10,000. And where I have on this portfolio at the close of the day today, I have basically 37% of that $1 million portfolio exposed to overnight risk. And on the swing trades, I have a 5K position in SHLD, which is an ETF for defense industries. I have a 10K position in Brazil, and then in Canada, we're going to see why in a minute. And then when I look at specific story stocks, I have 5K positions in Coca-Cola and Black Bear AI or Big Bear AI. And I have an additional 10K position in Coca-Cola. And the reason for that was it started Coca-Cola a few days ago, started off as a 2K position. It started improving. I added money to it so it became a 5K position. And today was a great big turnaround day intraday. And so I added a 10K position. And what actually happened was I was trading Coca-Cola intraday at much higher levels of risk, 20K or 30K or 50K, which represent 2, 3, or 5%. And then the money that the intraday turbo position earned allowed me to sell off most of that position and then use that money to fund the overnight risk that I'm willing to take on Coca-Cola. So what I like to do typically is use the day trading positions as ways to raise money and then keep pieces that allow me to build swing trade positions that allow me to take money over time. So if this was day one of the swing trade, I might do an initial swing trade position and a turbo position. So I have a large position intraday and then exit the turbo position before the close and then carry that money overnight in a swing trade. And then if it continues to go up the next day, I can put the turbo position back on. So I think of that as a core position that's going to stay in play as long as this thing is following the rules of the swing trade. And if that ever gets to the point where it hits an exit, then I will stop trading the turbo. But as long as this thing is behaving in a swing trade manner, I will use the intraday opportunity to do low risk entries to add turbo positions to allow me to make intraday money, which then helps me offset the cost of the risk of the overnight position. So that's what we mean by core and turbo. And I will typically start at the lower end of risk, earn some markets money, and then use the success of that to start adding to positions to grow the position. And then periodically, that intraday trade will then spill back over into the swing trade and allow me to minimize the risk to my core capital and use markets money in a clever way. So this all comes from the teachings of our legendary mentor, Dr. Van Tharp, rest in peace, with his creative money management strategies. I was a primary instructor for him for almost 30 years, and I've sort of internalized his special report on money management. This is typical of that. Now, the positions that I'm holding overnight, I was willing to hold 37% because a lot of those gains are from money that we made during the day. So I'm willing to risk markets money. We're in a sideways volatile market right now, so I don't like to have more than 40% exposed overnight. And what I actually have is some of these longer term positions that are deep in the money, like Brazil, Canada, Shield. This is these two are speculative AI and quantum computing things where I'm having a wide stop and willing to let them be volatile. I have United Health. I'm going to show you why that was an amazing trade today. And then Coca-Cola has made a turnaround as a non-technical or technological company that's making a good move after a long swing slide. We've got a double scoop of the triple leveraged Dow 30 and the triple leveraged treasuries, both of which are to turn around and perform really well today. So we're deep in the money. This is basically a position that they kind of hedge each other, that one will go up and the other will go down, and the net is usually pretty good. But both of those had strong days today. We decided to keep that posture exposed in a recovering market. We have a good, strong position in Mexico and in Canada, and then also a 30K position in the triple leverage Qs because technology had a relatively good day today. So what I have is about 40% exposure. I have a blend of Main Street and Silicon Valley. We have some international countries that are doing really well while the U.S. is suffering. These Canada, Mexico, and Brazil have been benefiting from the chaos introduced into the U.S. market by the administration. Shield is a defense hedge so that if the world gets more warlike, those typically go up. Rigetti Computing and Big Bear are both speculative plays on the AI sector in quantum computing. And then UNH, United Health, has been in a catfish and Godzilla pattern for the sniper, which is a extremely oversold and then has intraday recovery. UMAC or United or Unusual Machines is also, it's a robotics pure play. We've made a ton of money on that, on swing trades and day trades, and this is a trade that's fully funded with markets money. So I don't actually feel the same level of risk on those because I'm playing with markets money. I use this as my little template during the day, so at a glance I can feel where I am in terms of short-term, long-term risk, story stocks versus ETFs. How I use this to be able to plan a strategy to build positions on successful trades as we go. And that's what I want to say about that. I do want to say for the folks listening in or who listen to this later that these links are you can find that in a posting in the Slice app. My students all know this information, but if you find that posting there in Slice, you'll find a 15-minute video about how we prepare our daily trading plan, how we plan the use of time throughout the day. Both of those, they're about 10 years old, but they're so good that we keep using them. We've been trading this way for almost 15 years, and so far so good. The trading ecosystem in the background gives you a broader explanation of what I just said and the different styles that we employ. This little reading here allows you to understand what our daily report means in audio with the visuals, and then this one gives you a text-based explanation of our daily report. There's a lot of things that are in the daily report. It's about 20 pages. The first 10 pages are actionable signals, and that actually represents multiple strategies, multiple ways to do it. And you should look at this as a salad bar or a buffet where you pick and choose the things that you need. You don't have to understand the entire report of signals and then the background information on market opportunities. You don't have to master all of those. You should find the things that resonate with you and pick and choose as needed. And so I would view the description of the trades I'm about to give you as a way to start figuring out what resonates with you and how can you use that to your advantage. Right. So this is what I want to talk about. So United Health, we spent about 40 minutes last night in a coaching session talking about United Health. And this is United Health on a daily chart, daily bars, excuse me. And what I want to show is the different time frames that we consider and why United Health was on our radar screen today. So this purple box represents a 150-day look back. So we look at that as the long-term look back. And we find the highest high and the lowest low, which hit today. And then that establishes our 150-day range. This black box represents the last 30 days. The blue box is the last 10 days. The red box is the last 5 days. What I want you to notice is that 20 days ago, this stock was trading at $600 and everything was pretty good. It actually had a nice recovery after some decay and came close to its all-time high again. And then in a matter of about 20 days, it's gone from 600 to 250. Yeah, that's a 65% sell-off in the last 20 days. that is abnormal behavior. That sets up some emotional responses of fear and greed. So when we take a look at that, if we zoom in now on the last about 30 days, what we noticed was that from that high, there was an earnings failure in here from that little doji. Here, there was a earnings failure. And then that sort of established the condition when it crossed the 30 period Bollinger Band mean. This was a signal of increasing weakness and decay. And then a couple more system shocks. And then today, a great big sell off. Now, what we described last night was an opportunity to trade this intraday and then as part of a swing. And what we said was any price action below the support level of 300, we would automatically want to be short. And so when it gapped down here, we were prepared to put a bracket around that and then either trade a sharp reversal or follow it short. What it actually did was sell off hard and then rebound strongly all day. So we were actually able to trade that intraday with no overnight risk in what we call the sniper trade of the day. And that's the one I want to show you now. So in the sniper trade of the day, that's this one here. Let's figure the screen. Yeah. So these are some of the stats that we look. So this is now an intraday look. Here was yesterday's close. Here was that key 300 price level. You can see that it gapped down to here. So it gapped to here. And now when I see the size of that gap, I know that this is going to be an exceptionally large range day, statistically speaking, that the size of the gap predicts the size of the follow through. So when there's a large gap, its chances are it's going to be a large range day. The range stat or the R stat, we know that statistically speaking, a $27.71, so call it a $28 move, is what we call the maximum reasonable intraday move. Maximum reasonable intraday move. So it can move $28 and still be a normal kind of a move. So here it gapped down to 274 and it sold off all the way to the low of the day around 250. That's a $24 move from the open to the low of the day. That was still within the range of normal. And then from 250, low of the day, it moved all the way back to 275. It made a $24 move that way. So it actually sold off and then recovered. And we were able to trade that with our standard manageable risk box. In this case, we're using an R5 where we take the range stat and divide that by 5. And that tells us that we should be able to manage about a $5 stop. So what we do with our standard work on abnormal openings is we put a $5 bracket on that and we take whichever way it breaks out first, we take that trade. So it broke out to the downside. So we get short here with a $5 risk. It sells off. That orange line is the volume weighted average price. It gets to a swing low. It passes through the parabolic stop and reverse, through this, what we call the dragon, the 10 period moving average with a half a standard deviation Bollinger Band. And we make that cover when it comes back to the 30 period SMA. So so on 1 unit of risk, that returned a little over about 3R. So for every $100 of risk, you made $300 on that short side trade. When the price continued and crossed back above the VWAP, that's our signal to go long. And our idea is that it would return to close the gap, which it did almost to the penny. So we get long here, and there's our standard $5 risk, and we're using the VWAP sort of as our guide. And as long as it's north of the VWAP, we're okay. And then near the end of the day, because I don't want to have any overnight risk, I go ahead and take that exit. And then on the 1 unit of risk, we gain 1, 2, 2.5 units of reward. So the total deal for the day is probably about 5R, meaning for every dollar risked, we're able to gain about $5. So those are two standard patterns that we use. One of them is the gap, the large gap entry with the bracket, and then the supported spring crossing entry. There are some opportunities for what we call the COTA 2 or buying strength on dips. We didn't use that because we had other things going on, but we're always going to just use standard patterns, and these are the same patterns that on a daily bar we would take that as an entry. If these were daily bars, that's a standard entry for us. So the fractal patterns that we learn for intraday trading also work for us on swing trading as well. So that's the sniper trade of the day, and the key thing to notice is that it was set up by an understanding of the previous day's uh, location and volatility and price pattern, and clear markers for support and resistance, and the strategy that we should have on big gaps, and then trade that in a standard way until it fails to fail further, make a natural harvesting move, and then be ready for a reversion to the mean or reversion to the gap. And that's what we got. So this thing is still in play. Like today's price action featured absolute fear and despair and the beginnings of willingness to buy a quality company at a deep discount. The fact that it was able to close well above the volume weighted average price means there were guys willing to buy this at higher than fair market value and willing to hold it overnight. So I would not be surprised to see a continuation tomorrow. So any price north of 275, I'm going to be willing to buy strength, and I'm going to try to get my risk out of there quickly and then harvest any intraday trade. So this is going to be for the next 30 days, mostly a day trading symbol. If we start stringing together some recovery moves where you have an up day and then tomorrow's an up day and an up day, there might be a way to start capturing some of those positions for overnight risk. Now we have an overnight risk position on this that was fully funded by that 5R. And my idea is that I think when folks see that nice recovery tomorrow, there's a chance for that to be a gap up. And I think the market has a chance for a gap up. So I was willing to use markets money to be taking advantage of gaps of this size. So I'm putting some of that market money at risk. And so when I come back and look at my portfolio, the risk that I'm willing to take on the swing trade, that 10K, we made more than 10K on the day trading positions. And so we're able to fund that 10K with markets money. So I have more risk tolerance on that amount of money in the portfolio. Okay, so that's how we think about the relationship between swing and day trading. Typically speaking, the size of my position for intraday trades can be 10 times as large as the overnight risk that I'm willing to take, particularly when the market is in sideways volatile markets as we measure market classification. All right, let me take a look at some other patterns and things that we traded today, just so you can get a flavor for how this swing trading and day trading works together. Let me find that. Let's see. Here we go. So, I guess in no particular order, let's try this. What does this give us? All right. So this was the United Health trade from this morning. This was using 1 minute charts. Here was yesterday's close. Here was the gap down. And after a $5 move down, I was able to get this entry in, and I'm using an even tighter stop to get the initial play going. So I'm using actually only about a $4 risk. Maybe that's $5, and able to get short, just short of 275, and then covering down here on the first pass. And it turns out that there were a couple other opportunities to to get short, re-enter, and harvest all the way down that allowed us to capture that market's money. So that's what that initial pattern looks like. This is a typical harvest for me because I want you to notice that the volume weighted average price is right here. And in this was a nice gap down, but it's been an orderly sell off. And the RL10, the moving regression line 10, has already started to reverse. So this is not evidence of panic selling. If it was panic selling, you'd see big volume bars and big range bars like that. This is kind of an orderly processing of everybody that's going to sell. And so when you got a couple R in hand and it's failure to fail further and it's approaching the VWAP, that's a good time to just take a harvest. I hope that I always exit too early. Now we know that this thing went down as low as 250, but I'm perfectly willing intraday to take bits and pieces. That's all that I can carry anyway. And so I like taking chunks and making bank and ringing the bell and reducing my overall portfolio risk and get paid along the way. So that's typical of my intraday trading behavior. Let's keep going here. Let's find another one. All right, so this is Canada. Now I'm going out to the 3-day patterns now. So now each bar is 3 days, not 1 minute. But you'll know there now what I'm noticing here is this goes all the way back from this is May and this is December 2024. The last peak, that's where the RL10 we treat as the actual price. That was the previous highest high. When it started to sell off here and went through the parabolic stop and reverse, that caused the downward trend to be indicated. But the peak was here, and today it breached that. And so on that recovery, it sold off as low as 36 from 43. And the last, about 30 days, it's had a nice recovery. We've been trading that on the way up, but today was special. When that 6-month high was breached, I was willing to take another swing position at about 43 and a quarter with about 75-cent risk. And that's what a swing trade using the 3-day pattern, we call that pattern the emerging dragon, as it comes out of the sell-off and now makes a new high. That's actually a pretty good pattern for us. All right, let's look at this is so this is treasuries, TLT, that's the 20-year treasury, and I'm looking at sorry. So I had treasuries on there. Oh, I must have closed that out. We'll come back and find treasury. This is Rigetti Computing. So they were up about 25% yesterday. Was a great big gain for them. This move right here yesterday, that was a 3-day, was about a 25% move. It continued today. Yesterday's close and today's continuation brought it across the 30-period simple moving average. The PSAR has flipped, so it's an upside move. I'm looking for a target of a return to this price, which is up around 19. So there's a move from about 11 to 19. That's a potential 80% move. And we can use about a $4 stop and to get 2 units of reward to the upside. This is a log scale. So there's actually $8 of upside for a $4 risk. And I'm willing to give it that wide of a stop, a 40% trailing stop, in order to have a long-term opportunity to get some speculative money into cloud computing. Now, I use the purple line to show that that's the price target, and purple dots also to show price targets. The yellow dot for me means that I expect that if it gets to here, it's got to make a decision about is it going to continue to break out? That would be a very powerful sign, and I'd be willing to add a second position. But it may also get to here and then start to fail just like it did last time. And if it starts to fail, then I want to harvest. I want to keep about 70% of the gains that we make inside this tactical space. So I'm using that as a trade frame in order to plot out my decisions using visual graphics. Now, my trailing or my initial stop right here, if that lower support level breaks, then I'm ready to go double scoop short because the next support level is all the way back here. This is not support. This was unimpeded, unambiguous buying, and then this was the last support level. So if that support level breaks, then it's Katie bar the door, and people are going to be trying to bail out of this thing in order to avoid losses all the way back to about $2. So this a breaking of this support level at 6 would cause me to get short in a big way. So that's how I frame in both directions. Now I don't have a emotional bias on this thing. This is just a business man's risk. Let's see. This one is this is a 1.5 leveraged Google. So Google was a great AI company, quietly getting it done, extremely undervalued right now and oversold. So this is an intraday trade on a 1.5 Google GGLL, and these are 10-minute bars. And this was yesterday's close right here. So I'm looking at yesterday's high and yesterday's low down here. And what I noticed was there was from the close, there was a gap up and then a sell off and then a consolidation. And then it did not fail. It held this support level for like 3 hours. And so on the next rebound off of that support level, I was ready to take a small risk, to take an entry. And then this thing actually closed pretty well up around this level. My target was here, and that yellow dot tells me if it gets above there, I should be thinking about a second entry, or if it gets up close and starts to fail, I want to harvest, and that's what we did today. So this one returned a pretty nice chunk from 31.07 to 31.60 is about 50 cents on a 10-cent risk. So that's another about 5R in a great AI and tech company that every fund manager has to own if you're growth. And if it were to have failed, I again treat this is not support. First support is back here at yesterday's VWAP. And so I would have been short at 31 with a target of 29.50 for my first position. And if that were to break, I would add a second position short. So I'm actually taking this as a compound critical state. It can make large moves in either direction. That's how I play that. This was Walmart. They had a big gap down today because they said, hey, tariffs are going to be troublesome and prices are going to be raised. That triggered a big gap sell off and then a lot of volatility. But then the RL10 reversed. It comes through. This would be a normal entry for me. I was fully committed in other things. I wanted to see what it did first. It held support above the VWAP. It continued to start ready to break out. So I bought an entry here with a risk intraday down to here about $1.50, and it closed most of this gap today. This is 3-minute bars, and that looks like a low risk entry to me. You could have played it with a tighter risk box here just to the VWAP, but I was willing to give it some room. I position sized against a risk of $1.50 instead of a 50 cent so that I could have a smaller position and more time to react. This one was global defense, that's shield. This is on a 30-minute bar. And so what we've had here was in the last few days was a sell-off from 54 and a quarter. 1.5 days of sharp selling, including a gap down and then a sell-off a few days ago, and then some recovery, some nice recovery steps, and then to here. And then today there was a big gap up. And as soon as the 30-minute bar closed and then continued to break out, I treat this as the opening range 30. So I buy it long from here with this as my risk, and it closed up around in here. So it's already well on its way to recovering these previous price levels. And I was willing to hold a piece of that overnight. I sold off the intraday and used that to fund the overnight risk. And that is the position that you see in, see, when we look at, that's this 5K position in Shield right here was paid for by an intraday trade on a much larger position size, which made money. And then I just retained a 5K risk in Shield. So I'm using markets money to reduce my psychological feelings of risk and in a very volatile market. Actually, sideways volatile market, I should say, because we've had some recovery. This one is Alcoa. This was kind of the same thing. Huge gap down. This one was kind of a wild ride this morning. Closed here 29.50 yesterday. Big gap down to 27.95. It ran all the way up. There was no follow through. Pulled back. It came back to about halfway. Held support. The RL10 reversed. Crossed the VWAP. Crosses the PSAR. And so I'm willing to get long here, looking to close the gap. And I'm using the bottom of the RL10 as my risk. And so that gives us about a 40-cent risk. And I'm looking at about an 80-cent gain. So that represents a 2-to-1 return as a trade frame just to close the gap to yesterday. So that's how we make that trade frame. This one is, this was Bitcoin. So this is our BITX is a double leverage. This is a 3-minute. Here was yesterday's close. Here was the gap down when now we just noticed a sell off, comes back to test the VWAP, sells to a lower low, comes back, but now crosses the 30 period simple moving average. And that creates for us a supported spring crossing. So we take a risk at the bottom of the dragon, which is the 10 period simple moving average with a plus or minus half Bollinger Band. So that essentially gives us about a 50-cent risk. It moves up nicely. It pulls back. It holds support at the PSAR. And then it breaks out above the previous hump. So I speculate a second position in here because I've got about 3R in hand on the first position. So I use one of those to fund the risk on the second position because my belief is that if it's able to break through yesterday's resistance, it could keep going. And it actually did that. And as soon as it breaks north of that resistance, I take my stop and move it to here. So now the stop loss on both of these positions is here. So I will increment in, but then get all out. So this one is going to be at a minimum about a 4R win. And we ended up getting about 5R on the sum of two positions, then with no overnight risk because Bitcoin is so volatile and trades so actively in the aftermarket that there's no sense for me to take that risk if I'm not going to be actively trading it. So I'll just take my 5R and go home. And it trades with enough volume and volatility when the regular market is open that I'm willing to just trade it during those windows. This was the United Health, and I just wanted to show on that the entry on this thing. So you saw already the previous one where there was the close, and then it gapped down to here. We got short, and we covered in here, and then this became that entry, and then that was our risk. This thing ended up closing at about 275. So the whole rest of the day, it was actually really pretty strong. So there's reasons to believe that tomorrow, if it breaks above 275, there's no resistance in here whatsoever. And then the next play will be to close the gap and get up around 300 or 320. It's a $25 move from here to 300. So it wouldn't surprise me to see it take 2 or 3 days to make that recovery. And I'm willing to give it a chance by holding a piece overnight and then adding the turbo position back on. So that's what I want to show. So if you are a subscriber at Slice and listening to my voice, when you see me talking about core and turbo and adding positions and reinforcement and harvesting routinely, all I'm doing is I'm trying to manage the portfolio heat during the day so that I am comfortable with the amount of exposure to the total portfolio with each of those positions, and then manage position size accordingly. Try to find the things that are working, and then zero in and really dominate on those, and then make a decision in the afternoon about how much overnight exposure I want to have. I do want to just take the opportunity to say I'm looking in our campfire uh, collaboration area, which is where my students are posting reports of their trades. I owe some guys some feedback. So while I'm here, so you can get a chance to see how some of my students are trading these things. This is Brian Lancaster. He's trading basically 5 minute charts and in the Forex. And you can see what he's got is the dollar yen trade here. And these patterns work just nice, just as fine on currencies as they do on commodities and ETFs and stocks and futures. So here was the big sell off that establishes supported spring crossing. He takes a 1, 2, 3 entry. When it peaks, he takes the dragon exit and he makes a good 1R. There was a COTA 2 opportunity to re-enter in a couple places. He didn't take those, but he's able to pull in a nice 1R trade. Let's see, this one is, see what he has here. This is one where he's trying the supported spring crossing. It fails. He takes a micro loss. There was a stop and reverse available here. That's a COTA 2 short. This is another supported spring crossing that was available. This is the gold dollar trade. That is a high price entry. So is this one when that holds support and continues up. So there was a couple good trades available in there. You don't have to get them all. The market doesn't remember the ones you don't take. Let's see, that was gold dollar. Oh, this was we already saw dollar yen. Um, this one is the British pound US dollar. Again, big sell up. That was tradable, but when he's available, that's when he can take the supported spring crossing, gets the standard half an hour trade. That PSAR break allows for that short, and then this is a supported spring crossing that pays off. Look how beautifully these currency pairs trade on 5 minute charts. You should be very interested in these as a strategy, by the way. We have a course that's focused strictly on that. Here's one where he tries the US dollar short, doesn't work, so he cuts his losses quickly. There's another COTA 2 entry that was available depending on your time frame. Here's one where he gets 1.1R on the gold dollar. Again, the SSC. There's COTA 2 re-entries available. Look how nicely short that thing gets. Beauty. And then here's one where he crushes a short in the US dollar, Canadian dollar, classic 1, 2, 3 short, perfect 1, 2, 3 cover for about 2R. The COTA 2 entry was available here. That would have been the standard exit and the stop and reverse. So notice how nicely these currency pairs trade. Very smooth and orderly. You don't have to worry about gaps, and you can time it to your time of day because the market's open so often. All right, so that's everything I wanted to cover for tonight. Alex, are you still on board? Do you have any questions? Anything you want me to cover? I should have asked you sooner, but
no, just wanted to thank you. It was a great refresher of your technique in there. in an hour time frame, and a great motivator to keep going. Thank you.
Hey, appreciate it. Keep the faith, keep working. So if you're in the sound of my voice, every Thursday night, 8 p.m. Central, my intention is to come in and it's an open mic night or open office hours. I would, if you give me questions ahead of time, I can prepare answers, but you can just come in and ask questions. I'm happy to do my best to answer them. I'll always try to have materials, ready to discuss for the trades of the day or that week, or run you through student feedbacks. I'm going to make this video available to you in Slice, but also I'll post it on my Patreon feed and in our coaching courses, because I believe in making artifacts, record once, use many, and some of the lessons learned tonight will help folks that are in the coaching program in various locations to get going. So appreciate your time and attention. Keep your risk measured and your powder dry. Frame those trades, get in your zero state, know where your edge is, be professional, but be grateful and forgiving towards yourself, and cultivate that emotional resilience that we need in a challenging and difficult profession. You've got folks in our community of practice that are extremely experienced professional money managers, and we've been doing this for 35, almost 40 years now, and we have some ideas on how to acquire the professional mindset and build the resilience and the skills that we need to be successful. So we're happy to share, and we would welcome you in our community practice. So that's everything I got for tonight, Alex. I'll get the daily report pushed out to you here shortly, and looking forward to next time I see you. Take good care.
Thank you very much.